Welcome back. This is Brandon Christy from Retirement Benefits Institute. Hey, your federal health insurance is a major consideration when choosing what kind of death benefits you'll need to have in place for your spouse in retirement. For your spouse to continue on your federal employees health benefits or FEHB plan, after you pass away, you'll need to leave some level of survivor benefits. For this reason, most federal employees carry at least the minimum amount of survivor benefit, even if the spouse won't need the income replacement at death. If this health coverage is important to your spouse, consider taking at least the minimum survivor benefit. First, are you even eligible? On the other hand, if you are considering leaving no survivor benefit and simply picking up private life insurance to provide for income replacement after your death, there are two important factors to consider. The first, as mentioned earlier, is your spouse's health insurance. If your spouse is reliant on your FEHB, then you may consider taking at least the minimum survivor annuity. Second, are you even able to get private life insurance? You cannot just assume that you will be able to buy any private policy you want. You must qualify. Life insurance is first purchased with your health, then your money. Poor health can result in higher life insurance premiums and even denial of coverage, which in some cases can make the survivor annuity the more cost-effective option. Good health can have the opposite effect. The survivor annuity is not subject to these conditions. You're automatically eligible for coverage at a standard 10% cost. So, what are we saying? We're saying be a wise consumer. There's no easy way to determine which of the various levels of survivor annuity benefits and life insurance options are best for you. It ultimately comes down to a matter of personal choice. That's why we suggest having an insurance professional perform a needs analysis for your particular situation. Let's consider the case of Alex, who, like many federal employees, wants to make sure his family is taken care of in the event of his death. As a FERS employee, he will get an annuity when he retires at age 58. He is struggling with the survivor annuity options for his wife, Pam, who is also age 58. He knows that he can get a higher annuity benefit for the rest of his life if he does not choose a survivor annuity, but he also does not want Pam to struggle if he predeceases her or for her to be left without federal health insurance. As a FERS employee, Alex can choose 50%, 25%, or 0% for survivor benefit. For this example, let's assume Alex chooses the 25% option for health benefit purposes. Also, let's assume Alex has a high 3 of $110,000 with 32 years of service at retirement. So we're going to give you a chart that displays some of Alex's choices regarding his annuity options. Now, so let's look through the numbers. 110,000 high 3, 32 years of service. Alex monthly annuity without survivor annuity about $3,000. Alex's monthly annuity with survivor annuity $2,850. Pam's monthly survivor annuity when Alex dies $750. Alex's monthly cost of that survivor annuity $150 a month is taken away from the pension so that she can get the benefit at his death. So in comes the idea of pension maximization. It may be possible for Alex to take the higher annuity and still be able to provide for his wife's security in the event of his passing. He can use what is commonly called pension maximization, which uses life insurance to replace a portion of Alex's annuity at his death. This requires, in part, estimating how much Alex is likely to pay if he opts for a private policy instead of the survivor benefit options. Pension maximization starts by estimating the future value of your spouse's survivor annuity. In Alex's case, let's multiply the $750 she would get by a predetermined multiple based on Pam's age. In this way, we are able to estimate the future value of Pam's survivor benefit, which comes out to somewhere around $150,000. I'm not going to go through that calculation because it's complex, it varies by the individual, and it only provides an estimate. You need to see a professional to get this number right. Once Alex knows the value of the federal annuity, he may be able to use a combination of term and permanent life insurance policies to replace this future value. By looking at the premiums, he can compare the cost of private policies with the cost of the survivor's annuity. Carefully research life insurance policies and verify the length of time the policy is guaranteed. Oh, like that word, guaranteed. As an extra incentive, a few life insurance companies offer different variations of chronic or terminal illness provisions as part of their policies, meaning you may be able to get some of the death benefit early if you qualify for certain chronic conditions. Do not blindly accept the default survivor annuity. You are in control, not OPM. Your pension income will most likely be needed by your surviving spouse. Do your due diligence and be a wise consumer by knowing all of your options. Understand how your survivor annuity choices will affect your spouse's federal health insurance. Whether you pay for life insurance premiums, take the pension reduction that comes with survivor benefits, or both, know that it will not be cheap. Now, for further information to get help on this vital decision, the biggest life insurance decision you will ever make, let's be clear, you need to know the numbers, crunch the numbers, spend time on it. We're glad at Retirement Benefits Institute to be that first step in helping you. Call us at 877-864-1145 and we'll begin to help you make a wise decision so that you can be a wise consumer for this very large part of your retirement decision making. Well, this is Brandon Christy with Retirement Benefits Institute, and we look forward to hearing from you soon.